The market is closed, and SoFi Technologies Inc. stock finished the trading session at $25.96, a notable closing figure after a volatile intraday period. This final price, which marks a consolidation near its recent highs, tells a story far more compelling than a simple number. It's a reflection of the deep-seated tension between the market's expectation that SoFi is a volatile, high-growth fintech that's either a rocket ship or a speculative bet, and the reality of its recent financial results that show it is transforming into something far more stable and profitable. The expectation is that a digital-first lender lives and dies by loan origination, but the reality is that SoFi is actively diversifying its revenue streams, building out a powerful financial services ecosystem that is proving to be a much more resilient and sustainable business model. This fundamental shift is the core reason for its recent surge, and the lingering question for investors: has SoFi truly evolved, or is this just another temporary high in its turbulent journey? The stock's recent price action has been a masterclass in market psychology. For months, the prevailing narrative around SoFi has been defined by its aggressive growth, particularly in its lending segment. Analysts and investors alike have focused on its ability to originate loans at a rapid pace, a model that is heavily influenced by the prevailing interest rate environment. This focus created a certain kind of expectation that SoFi stock would be highly sensitive to macroeconomic shifts and would see its fortunes rise and fall with the broader economy's health. But recent data challenges this view. While its lending business remains strong, evidenced by a 32% year-over-year growth in adjusted net revenue from that segment in the last quarter, it's the other parts of the business that are generating the most buzz and showing a profound shift in the company's DNA. The financial services and technology platform segments, which are less reliant on interest rates, saw a combined revenue increase of 74% year-over-year. This acceleration is a critical development that most investors have yet to fully appreciate. It suggests that SoFi is successfully executing its super app strategy, with its technology segment, anchored by Galileo and Technisys, becoming a significant and high-margin B2B revenue stream. This is the reality that is exceeding expectations and driving a reevaluation of SoFi from a cyclical lender to a diversified fintech powerhouse. The trading volume on SoFi has remained elevated, a testament to the high level of institutional and retail interest in the name. Institutional ownership is robust, with major players like Vanguard Group and BlackRock holding significant positions. However, there has been some mixed activity among institutions in recent quarters, with some increasing their stakes, while others, like D.E. Shaw & Co., have trimmed their positions. This mixed sentiment from institutional investors reflects the ongoing debate about SoFi's long-term trajectory and whether its current valuation is justified. On the one hand, a company with a market cap over $30 billion and a P/E ratio over 50 is priced for perfection, and any stumble could be punished severely. On the other hand, the company's consistent earnings beats, with 4 consecutive quarters of surpassing EPS expectations, and its guidance raises indicate a management team that is not only delivering, but also confident in its future. The significant institutional buying, particularly from names like Bank of America and Valorage Investment Management, indicates that a large segment of the market believes the growth story is far from over and that the company's strategic pivot is a successful one. This is not a stock that is being quietly accumulated. It's a battleground stock where large players are placing significant bets on a specific outcome, creating the volatility and volume we've been seeing. Diving deeper into the company's business model reveals the full extent of this transformation. SoFi's core strategy is to be a one-stop shop for a consumer's entire financial life, from student loans and personal loans to a full-fledged individual brokerage, checking accounts, and credit cards. They refer to their customers not as clients, but as members, and the entire platform is designed to cross-sell products and increase member engagement. This is the brilliance of the model. Once a member signs up for a single product, say a student loan, the company has a direct line to them to offer other services. This is a model that a traditional bank or a legacy broker like Fidelity, with their more siloed product offerings, would struggle to replicate. SoFi's recent earnings reports have provided irrefutable evidence that this strategy is working. The company is not just adding members, but also increasing the number of products per member. This stickiness and a growing revenue base from less capital-intensive businesses, like its technology platform and financial services, are key to its path to sustainable profitability. The company's bank charter has also been a game changer, providing it with a more stable and lower-cost source of funding for its loans, further reducing its reliance on more expensive, volatile capital markets. For investors considering self-investing, platforms like SoFi Invest offer a user-friendly interface that brings all these pieces together. It's an entire ecosystem, and that is a major advantage. Looking ahead, the future for SoFi Technologies is a delicate balance of massive opportunity and significant risk. On the opportunity side, the company has announced plans to re-enter the cryptocurrency space and to introduce AI-driven tools, positioning itself at the cutting edge of financial technology. It is also exploring business banking services and loan tokenization, which would make its loan products accessible to a wider range of retail investors. These initiatives are all designed to deepen its moat and create more revenue streams. The potential for SoFi to become the AWS of fintech through its Galileo and Technisys segments is a massive and often underappreciated catalyst. However, risks abound. The company operates in a highly competitive and heavily regulated space, going head-to-head with not only other fintechs, but also established giants like JP Morgan and Bank of America, which are rapidly expanding their own digital offerings. Furthermore, despite its diversification, a significant portion of its revenue still comes from lending, making it vulnerable to economic downturns and a potential rise in loan defaults. This is a crucial tension for investors to monitor. The expectation is that the growth will be linear and smooth, but reality dictates that it will be bumpy, with macro events potentially creating headwinds. Comment below how many shares of SoFi stock you currently hold. Do you see it as a long-term hold or a short-term trade? In conclusion, the story of SoFi Technologies is a fascinating one of a company that is not just meeting expectations, but actively reshaping them. The initial narrative of a volatile, growth-at-all-costs fintech is giving way to the reality of a disciplined, diversified, and increasingly profitable financial services company. While its lending business continues to be a core driver, the accelerating growth of its technology and financial services segments is the real differentiator, creating a more resilient business model. The battle between the narrative of a risky lender and the reality of a fintech super app is what is driving the stock's current trajectory. Its future depends on its ability to continue executing on this strategy, navigating intense competition and macroeconomic risks, and proving that its land and expand model can lead to a sustained and durable profitability that makes it a top-tier financial institution of the future. The question is no longer if SoFi will succeed, but how quickly it can complete its transformation from a niche player into a true leader in the new digital financial landscape.